So it's been 21 years that I am fully invested in the stock market. I started with oil income trust back in 2003, starting buying and selling, buying my first house, going through the financial crisis of 2008. And then I started to build a simple and efficient investment strategy. Today, I wish I had learned a lot of lessons because I made some mistakes and I, of course, lost a lot of money along the way. So today I'm sharing with you 21 lessons that I've learned over those 21 years of investing. So let's get started. The perfect time to invest is now. I know you're tempted to wait and see what's going to happen next, or you don't want to pay too much for stocks or for an ETF. I've worked as a financial planner for over 10 years, and we used to do an interesting exercise. It was to identify one very good reason not to invest for each year on the stock market. So based on the economy stats, based on the market events, whatever happens. Ironically, since 2003, I can line up 21 really solid reasons not to invest. Could you imagine that waiting on the sideline and the impact on your portfolio? That would have been terrible. So the best time for me to invest was in 2003. The second best time to invest is today. Lesson number 2, news equal noise. I know the internet is full of information. You want to consume everything, you want to know everything, and you want to make informed decisions. The problem is a lot of what you listen to, watch to, read about is completely useless because it's not going to be right for the next 4 hours. Here's a good example. At the beginning of February, Trump announced tariffs over the weekend. I already had a podcast prepared for the Moose on the Loose on the morning. It was about a company, TerraVest Industries, so nothing related to tariffs. One listener said, well, I'm a bit disappointed that you didn't cover the tariff story, which is a much more important news. Well, the thing is, if I had recorded something on Sunday or Monday morning about tariffs, it would have been good for a few hours because at the end of that day on Monday, another news came out that we would have a 30-day period grace for Canada and for Mexico, that there will be no tariff for now. So spending so much time to chase the news will just confuse you and will get you stuck into paralysis by analysis. Lesson number 3, what I think will happen just won't. It's fun to try to predict the future, and I'm always trying to see what's going to happen and try multiple scenarios in my head, but I try to not make any movement with my portfolio. For example, I've been thinking that we are about to go into a recession in Canada since 2022. So it's been 2 full years and entering into 2025, still thinking that the recession will happen, but I would have been wrong for 2 years already. So if I would have sold a good part of my portfolio waiting cash there, it would have been a huge mistake. So whatever scenario that you put in your mind, chances are it's not going to happen and unfold as you think it would. Lesson number 4, safe investments are risky. As a financial planner, sometimes we had clients that wanted to go safe. They wanted to go with GICs, like certificate of deposits. In French, we call them guaranteed certificate of poverty. Why? Because when you factor in inflation and taxation, it's not even enough to protect your buying power. So long story short, the more you go for safe investments, the more you're at risk of not preserving your buying power. A good balance is probably the best option. So I'm not saying that fixed incomes are bad, far from it, but just reaching the right balance to meet your retirement plan is the perfect way to do it. Lesson number 5, don't listen to your friends' ideas. And by friends, I mean your brother-in-law, family member, your father, your best friend, your cousin. We all hear those stories about someone in your entourage that is making a ton of money with an investment. Well, good for them. Sometimes they will be right, sometimes they will be wrong. But if you don't know what you own and why you own it, it's a very bad idea to borrow someone else's ideas, but not his conviction. Lesson number 6, high yield come with a high price. High yielding stocks, companies offering above 4% yield, are coming with a set of risks. And it's not true that the dividend will be there forever. There is a reason why the company is forced to offer you such a generous yield. And if you don't know that reason, well, you're making a mistake by investment. So it's not all high yield that are bad, but you just have to understand what you're getting into your portfolio and the risk that comes with it. Lesson number 7, I don't care if I'm right or if I'm wrong. There is a lot to put in for your ego there, but it's okay to be wrong. And you're going to be wrong several times. So you don't have to be wrong. You don't have to be right. What you must do is to follow a strategy that is aligned with your goals. So I don't care if Johnny Buddy 123 argues with me on X or on YouTube telling me that my strategy doesn't work or his is better. Good for him. He's not going to pay my mortgage. He's not going to fund my retirement. So I might as well be wrong or be right, but follow a clear and efficient investment strategy. Lesson number 8, diversification is key. Following up to you don't have to be wrong or right all the time. Well, the best way to protect your portfolio against yourself is to be invested in multiple industries. That diversification will shield your portfolio against a market event that would attack a specific industry. Think of like the tech bubble of 2000. If you had 40% of your portfolio in the NASDAQ, you took a major hit. But if it was like 15, 20% and you have invested in a lot of other companies that has nothing to do with technology, well, then you did well and you recovered quickly. And that's the whole point about diversification, is you don't have to be right. Lesson number 9, don't get seduced by a great story. You know, I often refer to the investment thesis that must be backed by financial metrics. So in other words, the story I tell myself about a stock must be backed by numbers and by facts. I forgot that when I traded Algonquin Power, AQN, a while ago, and I paid the price dearly. I was seduced by the growth by acquisition story, the fact that the company kept on buying utility assets and transforming them in the greening process with more wind and solar energy. That was a great story. The numbers were doing well, but I ignore numbers. I ignore debt. I ignore funds from operation. And I, of course, ignore the higher interest charges that eventually kill the company and force the business to cut their dividend not only once, but twice. So next time, when I'm not too sure about a stock, I make sure that the story I tell myself about the company that I own is backed by robust financial metrics. Rule number 10, the CEO doesn't care about your dividends. That is often something that we maybe think of. Well, CEO, the management team, their interests are aligned with mine. Of course, they want to make the company great and they want to thrive. So I'm going to thrive as an investor as well. But when things go sideways, CEO doesn't care about my dividend. He cares about his job. He cares about the survival of the business. And if he has to cut the dividend to ensure that he gets his budget in place, well, then he's going to do it because he doesn't really care about my retirement. He doesn't care about whether or not I will live off those dividends. He only cares about the survival of the company and, of course, the survival of his paycheck. So he will not hesitate to cut an outflow for the business that is the dividend. Don't take it for granted. I'm taking a quick pause here to ask you to subscribe to the channel and like this video if I'm providing some value. Let's share the wealth and take a pause, go in the comment and share with me one lesson that you have learned since you started investing. So therefore, we're going to build a longer list than just the 21 lesson I'm sharing with you guys. Lesson number 11, valuation is as accurate as astrology. I know, that's a big one to take. For a long time, I thought, well, I want to buy undervalued companies that will thrive in the future. This is exactly what I did when I got into BlackBerry while the stock was going from like $120 around $70. I thought, well, that is probably a pretty good time to get into it and I'm going to make a lot of money on it because now it's undervalued. Well, the problem is iPhone kept on eating up all BlackBerry market shares and eventually my dear research in motion just fell off a cliff. Fortunately, I was quick on this one. I sold and just took my loss as a good investor, but still it hurt. And when you're thinking that you're buying a stock at a good price as a fair value, well, keep in mind that the valuation that you've put in is just calculations based on assumptions, and your guesses are just as good as mine. And if you put 10 financial analysts in a room and you ask them to calculate the fair price of a single stock, you're going to get 10 different fair price. So in other words, they're all trying to foresee the future. And in the end, as an investor, you're going to be rewarded for what the company will be doing for the next 5 to 10 years. The problem is, I don't know what the company will be doing in the next 10 years. You don't know either. And those financial analysts, they don't know that much either. So buying quality stocks instead is a much better way to achieve financial freedom. Lesson number 12, the end of the world will happen every single year. I remember when I was a financial planner in 2008, that was a big catastrophe. Every single day, the market was down 1, 2, 3%, and it couldn't stop. My clients were calling me. I was reaching out to most of them, sending newsletters, explaining what's happening. But at one point, I was like, maybe it's the end of capitalism for real. I was young. I was learning the ropes. And then I realized over time that the end of the world is always around the corner. You know, in 2008, banks would have collapsed, and that would be the end of the banking system. In 2012, European countries such as Portugal, Ireland, Italy, Spain, and Greece were all about to go bankrupt and destroy their Eurozone. We had the Brexit that would have destroyed the UK. We had the pandemic that would have destroyed and locked down the entire world for at least 4 or 5 years before we find a vaccine. So as you can see, there's always the end of the world just waiting around the corner. These days, you might argue it's Trump, or it was like the inflation and high interest rate not too long ago that would make the housing markets collapse. It's not happening because human beings adapt. And companies are run by human beings, so companies adapt as well. The end of the world is not around the corner. Lesson number 13, home runs happen when you wait. When I was a kid, I used to play ball, and I was a power hitter. I was like always number 3 or number 4 on the lineup, and I used to crank it and love it. The thing is, after I crank it out of the park, most of the time I would do 1, 2, or 3 strikeouts because I was not patient anymore and I was just thinking about hitting that ball as hard as the first place. Well, investing is the same thing. Whenever I think I'm going to hit a home run with a short-term play, most of the time it's not necessarily going that well. And when I look at my top performers, companies like Microsoft, Apple, Alimentation Couche-Tard, National Bank, those are all companies that I've been holding for years and years and years. And now, well, they're showing 3 to 4 digits return, which is kind of crazy. But that just happens when you buy a great stock and you hold on to it for several years. Then you get rewarded with an home run. Number 14, not doing anything is usually the right thing. Many times when I was younger, I used to trade almost every week, trying to adapt my portfolio, seize the opportunity, avoid a bad investment. And as I age, as I build a more solid investment strategy, I realized that in many cases, not doing anything is the best way. You know, your portfolio is like a bar of soap. The less you play with it, well, the better it is. Because if you keep on playing with that, it's going to reduce very quickly. Number 15. Never sell because I lose money. I'm pretty sure you're like me. I hate losing money, and I'm sure you do too. I hate having losers in my portfolio. Whenever I open my brokerage account, I see those red lines. It drives me crazy. When I was younger, I tried to cut my loss as soon as possible and then move on. And then I realized something interesting. The market is volatile. It goes up, it goes down, and sometimes while I thought I would avoid a 15, 20, 50% loss, the stock just dropped by 10. And then a few months later, it would have bounced back and then recovered. So making a decision based on short-term performance, either up or down, is a great way to leave a lot of money on the table. Number 16, never sell because I make money. Yes, number 15 was about losing money. Number 16 is about making money. Again, if I put a cap of like 50% or 100% return on a stock and then I sell right away to protect my profit, I would have avoided having Apple in my portfolio for so many years that now it shows 1,500% return. That would have been crazy, right? Imagine all the money that I would have left on the table. And that's just one example. So instead of buying and selling based on short-term price fluctuation, I rather have a solid investment thesis. So the story I tell myself about the stock and why I think it's going to go well going forward, and being backed by robust financial metrics, focusing on the dividend triangle, the revenue, the earnings, and the dividend trend instead. Number 17, leverage can go a long way. Of course, leveraging is not for everyone. If you borrow to invest, there are a lot of risk, and you want to make sure that you are set for this type of strategy. But for me, it was just an amazing story. In 2003, I borrowed $20,000 from a line of credit and I started trading. 3 years later, I was up by $70,000. So I had $50,000 of pure profit that I could put on a house as a cash down. That was just an amazing way for me to start on the right foot. Of course, I got a bit lucky because trading between 2003 and 2006, that was kind of easy, similar to what we just had on the stock market. But still, if you can use leverage to grow your portfolio when you're younger, and if you have a high risk tolerance and you have liquidity to pay for that loan, that could help you build your net worth a lot faster. Number 18, get ready to lose $100,000. I probably lost about $100,000 over all the bad trades I've made in the past 21 years. I haven't done the calculation because that would have disappointed me big time. But the point here is, whenever you invest in the stock market, you're going to make mistakes. And when you make mistakes, that means that you may lose money. And it's all right to lose money, because if you're ready to lose such a large amount, what's going to happen is whenever the portfolio goes down, you're not going to blink. During the market crash of the COVID in 2020, I saw my portfolio going down by about $100,000 back then. I didn't flinch. I didn't do anything, actually. I actually used my previous lesson about not touching my portfolio and just waiting to see how this story would evolve. And that was the right thing to do. Eventually, the portfolio fully recovered and it continued to grow. So it's important to be ready to lose that money on paper, but not in real life. Number 19, investing is not gambling. When I started investing, I was young. I just thought that I could just buy a lot of stocks, make a lot of money, and then trade like Warren Buffett. And I thought going in and out was the best way to do this. And it actually worked for a long while. So I thought I was an investor, but in reality, I was a gambler. I was just gambling because I was trading on very thin amount of information. And I was just like going back and forth on several trades just to generate some profit. Today, I study, I learn, and then I make sure that I know what I own and why I own it for a very long run. This is what I call investing. Trying to make a play on copper, trying to make a play on the next big tech that is going to disrupt the industry, that's gambling. It's good for some people, but I've learned that it's not good for me. Number 20, simple is better. When I started dividend investing, it was in 2010. So I've been 7 years in my journey. I had like a MBA in financial services. I was a financial planner for a few years. So I kind of like learned a lot of things about the investment market and how I would invest my portfolio. I decided to go with dividend growth investing. And back then I had a lot of rules. That was good guidelines. It helped me build my portfolio, and that was prevented me from making a lot of mistakes. But sometimes I felt it was a burden to follow all those rules again and again and again. So it became cumbersome, and it increased the paralysis by analysis because I had to focus on too many things at the same time. Over the years, I've simplified my investment strategy, focusing on the dividend triangle as a primary state of analysis, and it made my life so much easier. Today, I follow about 5 investment rules to manage my entire portfolio, and that brings me clarity so I can make fast decisions and not regret it. I can invest with conviction. And finally, one of the most important lessons that I've learned throughout my journey as a dividend growth investor was that low yield, high dividend growth companies are actually safer and report better returns than high yielding stocks. After reviewing so many companies, so many results, so many total returns, I realized that the low yield, high dividend growth businesses, they don't come with more volatility than any other stocks. Actually, it's quite the opposite. They have less volatility, they grow constantly, they're thriving, and they reward their investors handsomely. For all the other stocks, well, they come with volatility, they come with high risk, and that it could become a problem at retirement. If you're curious about this lesson that I've learned about low yield, high growth stocks, I invite you to download the Dividend Income for Life guide at dividendstockstocks/income. The link is in the description below as well, where you're going to learn more about my strategy, how I built my portfolio, and how you can do it too. You'll see it's simple, it's clear, and it's effective. All right, guys, that's enough for today. Don't forget to subscribe to the channel and like this video, and go in the comment. Tell me the #1 rule that you have learned throughout your investment journey. Let's share the wealth and let's help each other. All right, guys, don't wait. Don't forget that we're going to have a new video next Thursday. And until the next time, don't forget to stay invested.